Welcome, Dana. I'm super excited to be chatting to you today.
Thank you,
I've
Kim.
known Dana for a few years. He's an exceptional M&A specialist out of Cape Town who operates globally. And I've got to know him over Wim Hof ice baths and many a EO sort of experiences. So I'm super stoked to have you in studio today.
It's fantastic to be here. Thanks for inviting me.
So I'm really curious about your sort of story and sort of key inflection moments or points in your life that led you to where you are today.
So how I got into M&A, how I got into selling companies.
I mean, yeah, that would be a great start.
So I think there's the how I got into it, and then there might be the why I got into it. How I got into it was quite simple. I was a technology entrepreneur. I was running my second company. We're doing very well, and we just received an offer to purchase the company. And my main shareholders said no, and I was pretty deflated by that. And at about the same time, some investors from England were looking to make an investment in a technology company. And so they asked me to do some due diligence. And so I rolled up my sleeves, I got under the hood, and I analyzed the company and really loved it. It was just fantastic. They loved the report, and so they asked me to join them in London. And so I exited my tech company, and I went to London. I got into corporate finance. So that's about the how. The why would be I come from a scarcity mindset, so everything was very scarce in my family growing up. So from a young age, I became quite determined to be successful and to be able to provide for my family in the future. And when I was about 16, I was invited to a holiday home in Clifton in Cape Town. And when I discovered that my friend's cousin owned not only the flat, but the entire block, I just sort of quite quietly asked, what did he do? And he was in private equity and corporate finance. And I said, well, that's what I'm going to do. So I didn't pursue it, but the stars aligned 8 years later.
Amazing. Thank you for sharing. So I'm curious. I mean, I think one of my big regrets when I exited my company was not having an M&A advisor. And I really wish I had. There's a lot of debate about whether it's worth bringing on an M&A advisor. And I suppose in many cases it might not be. But, from your perspective, when is it a must-have versus a nice-to-have?
If you take a step back, I think whenever you are confronted with something that you're not an expert in, it would be a good idea to surround yourself, or at least consult an expert. So I think probably in all but the simplest of businesses and transactions, I would highly recommend being advised. A strong corporate financier, I think you need 3 types of advice in a transaction. Commercial advice, which is where the corporate finance comes in. Legal advice, that's creating the container to implement the deal that you've done. And then optimizing the transaction, which is often tax advice. So whenever we do transactions, we really bring those 3 together.
And is this something you do in-house, or do you work with specialists yourself? Or?
We work with specialists. So we work with tax advisors, and we work with, I suppose, the majority of the legal firms, but I got my preferred corporate lawyers.
Got you. So I'm curious to understand, I mean, you mentioned earlier that you operate from like the seller's point of view, right? So you're really in the seller's court and on their team. I'm curious about understanding the valuation from the buyer's perspective. So when we're talking about value, how are buyers thinking about value today? Like, what's behind the number?
I think value is probably one of the most interesting topics to discuss. There's definitely 2 perspectives, the buyer's perspective and the seller's. So whenever I'm asked what's the business worth, the first question is, well, who am I acting for? But I think if you put perspective aside, the intrinsic value of any asset is a function of its free cash flows. A lot of jargon in that statement, but basically whether you are buying a bond, investing in a listed stock, buying a property, or just about anything else, you can express the value of that business as all the cash flows that it would generate from now to perpetuity, from now to the future. So the most accurate way of capturing that is to do a 5-year financial forecast and then to produce a discounted cash flow valuation of the business. Now, that captures all of the business, all of the value that's in the business, and it's risk adjusted and expresses the value in today's terms. That's called a net present value. Now, buyers, obviously there's asymmetry of information. The buyers don't know what you know, and they tend to want to get a return on their capital within 5 years. So they don't want to know about the cash flows this business will generate in 20 years' time and pay you for it. They want that value for themselves and they want the capital back. So their perspective is driven by their return on capital employed, and also other strategic drivers and value that they can unlock from the business. But mainly they look at their return on capital.
Got you. So a lot of EO members that I've spoken to have created lifestyle businesses. So perhaps they were an expert at something and really were passionate about, about starting their own business or being an entrepreneur, or fell into it for some reason. What are your thoughts about running, sort of for founders running lifestyle businesses? Often it's profitable, but not necessarily scalable. Is that a business that you can sell? Have you had experience with lifestyle businesses that have sold, or any advice there?
So yes, you can sell any business. I suppose it just depends on what value you're going to get for it. I think if you're running a lifestyle business, the value is a function of the income stream that it generates for you, by way of a salary, also any dividends that it produces for you, and then ultimately, if you do sell it, you sell it for capital value. That capital sum is meant to express all the future potential dividend streams. That's why it's about free cash flow. And quite often when you're negotiating transactions, you might get a value that's equal to, say, 5 times profit, or maybe a bit less, or maybe a bit more. And that's essentially 5 years of earnings. So if you're running a lifestyle business and you're enjoying it, sometimes the annuity value of the income exceeds the potential value you can get by selling your business. So I would often advise people not to sell their business if they can afford not to. If it's enabling their lifestyles and it's not too stressful, then rather don't sell. I think a strategy that does work pretty well is do some succession planning, empower your team, and see if you can exit the business to the team that have helped you grow it. And in those circumstances, you can allow the business to fund the purchase, because often your team of key executives and directors might not have the funds to do it. And there you can unlock, say, a more appropriate value and justify the exit.
So kind of like a management buyout.
Management buyout would be great, yeah. And it's typically vendor financed. It might be part, depending on the size of the business, but it might be part debt financed by a bank and then part financed by the cash flows of the business.
And how keen are banks to finance a transaction like this?
Very keen, yeah. And it depends on the fundamentals. When banks lend you money to buy something, they'll look at the asset underpin, so they'll look at the value of the assets in the business. But probably even more importantly would be serviceability. So can you fund the interest and capital repayments that are required? But they're very happy to do it. All the banks are quite active.
Interesting. So I've spoken to a few EO members from around the world, and one of the concerns is, how do I know if I'm getting the right advisor, right? How do I know if I'm getting the right banker or the right M&A advisor, and how do I know that they're truly aligned to my goals? What's in it for them versus what's in it for me? So how would you advise people, if they were thinking about an exit, to go about reviewing advisors or aligning their interests with their advisor's interests?
I would start by saying meet more than one potential advisor. It is about chemistry. It is about trust. I think you're trusting the advisor with probably one of the top 5 decisions, and the most important decisions you're ever going to make. I think to create alignment, I think a fee structure is important in the alignment. If you look at investment banking, at a global scale, and you deal with global investment banks, they don't charge fees along the way. They don't charge retainers. They only charge a success fee. If you look at corporate financiers and I suppose people like myself, we charge retainers, which are a work fee, which is really a commitment to the process, and then we charge a success fee. And the success fee basically aligns us with the outcome of our client. So maybe a few things. I would say pre-2008, there was a fee model called the Lehman scale. So all M&A advisory fees were priced on the Lehman scale. And that's basically a declining scale. Very unfortunate. That's why it's no longer used. But it's a declining fee model. So if you're selling a listed company and it's worth $1 billion, so its market cap is $1 billion, or a business that's worth $10 billion, it's the same process. And because there's a lot of analysts out there following the business and writing about it, basically the view is it doesn't take any more work to sell a business that's worth 10 times more. And so you pay relatively less the bigger the business goes, and it tends to about 1%. So for very large transactions, you can pay 0.8 of a percent, or so 80 bips to 1%, 1.25%. So I prefer to invert that model. So we came up with a model where we said, well, the first X of value is quite easy to achieve. I mean, anyone could sell their business for a number. So we'll charge a lower percentage for that initial level of value,
right,
and then a higher percentage for higher value, and then maybe a third tier as well for knocking it out of the park. I also think making sure that your advisor gets paid when you get paid. So, once success is achieved, you might find that there's an upfront payment, but the acquirer is going to pay you additionally over the next 3 years through a deferred consideration structure. And then for that to be baked into the fee model, so the advisor gets paid when you receive your cash, might also create better alignment. The reason why I think a retainer is essential is because you don't want the buyer to feel compelled for you to do. Sorry, the advisor to want you to do the deal because they're desperate for the fee.
Yeah.
You want the advisor to be in your camp and rather say, this isn't the right deal for you. Let's rather circle back and come to the market later, or let's rethink.
Yeah, 100%. And so what's interesting is that through my interviews, I'm interviewing 100 post-exit founders, and many of them shared with me that they never imagined they would achieve the number that they eventually did. And it was the M&A advisor who actually said, no, hang on. Don't just look at EBITDA. What about future partnerships? What about if we unlock this capability? In one instance, it was an acqui-hire deal where it was about the number of staff. And so this particular entrepreneur was so genius. He went to the negotiation table, had a look, okay, that it's not about necessarily revenue and EBITDA. Yes, that's important, but what they're really wanting is a solid team who can do a great job. Let's say he had 50 staff members at the time. He said, give me 2 years, I'll see you back here. He went and acquired a much bigger business and came back with let's say 150 staff. And suddenly he knew, and that advice was given by, with the support of his advisor. And a regular entrepreneur might just say, well, I'll value the business at 5x, or as you mentioned now, or hey, a PE of 9 or whatever. And I thought that was such a wonderful insight, is that having someone in your corner who's prepared to sort of go to war with you is quite useful.
Absolutely. I mean, so we call them value drivers, but you've really got to understand what's the acquirer buying. And sometimes they're buying your product. So, sometimes they're taking a competitor out of the market. Sometimes they're buying a customer base or geographic presence. It sounds like in that transaction they were buying capacity and time to market. And acquirers, say in the States, they would tend to put a value on each head. And you'd simply say, well, 200 heads, $250,000 per head. He has a value for a ready-made tech team that I don't have to hire, train,
right,
build the cohesion, etc. So yeah, that makes a lot of sense. That is certainly part of the art. I think metrics and multiples. People tend to negotiate deals based on multiples. So they start with, "I'll buy your business for 5 times profit" or something like that.
Yes,
and that sort of really has, your business is not a function of, it's not a value of 5 times profit. Your business is a function of its future cash flows, and you need to understand what that value is.
Yes.
And that's your standalone value. So that's the value before you consider what the acquirer can do with it, what synergy can they unlock, and what's the strategic driver. And a good corporate finance advisor will unlock that and get to the bottom of it. We've got a process that we use to do it, where we build shared, basically a joint business case. Mm-hmm. We do a lot of ideation, and we look at the synergy cases, and then we factor that into the value, and that allows you to negotiate a premium, but also value share in some of the in some of the strategic rationale for the deal.
Got you. So it's not that sort of agency dilemma where you have a sausage factory of deals going, crossing the table, and it's just go, go, go. We got to sell. It sounds like there's a lot more intention and a sort of perhaps a slower and more intentional process around selling.
So I think there are advisors that really sell at market prices and really do volume, and then there are advisors that look for strategic alignment and strategic premiums. It takes exponentially more work to extract a premium outcome, but it's certainly worth it for the seller. And ultimately the buyer needs to be prepared to pay it. So we've done some staggering transactions at very, very, very rich multiples, but the buyer ultimately was prepared to pay it, and they were happy that they were going to get their return on capital and their basically what they were looking for, their IRR.
100%. So I've interviewed over 50 post-exit entrepreneurs to date, and I've got 50 more to go. And what's interesting is that there are these inevitable highs and lows, right? And one person said to me, the higher the goal, the deeper the hole. And often people who have got arguably enough money to last in their lifetime, sometimes even their children's lifetime, have got this feeling of like inner turmoil and rudderlessness, etc. Can you think of one example of someone who felt truly content, both like emotionally, sort of obviously financially after the exit, and what made the difference in that story?
So I've sold over 150 businesses, and we put a lot of energy into how we go about doing it. I think I would say the mindset of the seller and being ready to sell, being prepared to sell, and understanding what that means. I think if the exit achieves the objectives, I think that's really helpful. So it's not always about money, or not always just about money. Sometimes it's about it's about a legacy. It's about a great home for your team. It's about looking after your customers. So there's lots of other drivers and sort of soft issues that come into play. But I think being prepared and really working through it is pretty helpful.
Got you. So in closing, if you could leave one piece of advice, and this is EO, so maybe I should rephrase it like an experience share. But I'll give you permission, it's not for him. If you could leave one piece of advice for a founder who's thinking that they might want to sell in the next 3 to 5 years, what advice would you offer?
I would say start preparing now. It takes a lot to shift the needle. Mm-hmm. So, I think start optimizing your business. There's lots of things that drive value, from business models to incremental value from your client base, getting your cost base right, driving your efficiencies within your business, also quite important. If you're not planning to be in the business and be locked in for a long period, make sure that you've got your team right and that you've done your succession planning. I think start understanding who you're going to sell to and be intentional about it. We should be living out, well, there's the word should, but living intentionally, I would say exit intentionally on your terms.
Wonderful. Dana, thank you so much.
Absolute pleasure, Kim.